Welcome to the Rosenberg Roundup. I'm Dylan Smith, and I'm unsupervised today. Jacob is off for a proper honeymoon in an undisclosed European destination, but that's his loss. He's missing a big week because the global cutting cycle has commenced officially, at least outside the US. We'll cover that in our roundup this week, alongside some commentary on the ever-softening US data flow and what to look out for next week on that front. In our Spotlight, we'll be taking a look at the stock market and in particular, where to find value in a highly stretched and highly concentrated market environment. So, let's get started. Starting off with the week in review, and with Jacob out, we're giving a big promotion to Canada Corner. And that's because what the Bank of Canada did this week matters for everyone who follows markets, not just Canadians themselves. And that is that Canada became the latest central bank and the most significant, after Sweden and Switzerland, to begin easing its restrictive monetary policy stance. It cut its benchmark overnight rate by 25 basis points to 4.75%, so still a pretty restrictive territory there. And the press conference that Governor Tiff Macklem and company gave after the decision was fairly constructive. They were clearly pleased to be able to deliver some popular news for once, and they did promise to do more on the cutting front if inflation continues to trend down. That said, though, they are central bankers and they did hedge their bets. They flagged upside inflation risks, particularly from rent, which, as we've discussed here before, we think is kind of insane. And they were careful to use words like steady and gradual to describe the rate path going forward. Now, the reason that we're starting here in Canada Corner is because it's actually a highly investable theme, we think, for investors globally. Markets are only pricing 3 more 25 basis points of hiking by next May, at least as we go to recording. But we think they'll almost certainly do quite a bit more than that. So it's a good time to load up on Government of Canada bonds. Now, the widening divergence between US and Canadian rates is putting us in what we're calling a low-for-long loonie environment, the loonie, of course, being the Canadian dollar. And sustained loonie weakness, which changes the earnings profile of Canadian firms, provides an investment opportunity. So we published a deep analysis on this earlier this week. Check out our website, but it was also picked up in the Canadian press. The upshot of that research is there's stuff to buy like manufacturers, transport companies, utilities, media, the type of exporters who do well out of a weak dollar or who benefit from lower rates. And the places to avoid are retailers, banks, and insurance companies. So there's a lot of rotation that should be happening in the Canadian stock market as we commence on this cutting cycle locally. On reflection, maybe this should have been called North Atlantic Corner because the ECB immediately followed suit the next day by dropping their own benchmark rate by 25 basis points. That was a move that surprised absolutely nobody since they had basically telegraphed the whole thing well in advance, European style. But the cut decision did come alongside an upward revision in the forecast inflation path, and the President Lagarde expressed a lot of concern over the pace of wage growth. The statement kept the language on needing to keep policy restrictive as long as necessary to bring inflation sustainably to target. And the ECB also followed through on earlier announcements to reduce its balance sheet size. So this is what we would call a hawkish cut. And President Lagarde seems at pains to prevent markets getting ahead of themselves the way that they did on the Fed around December time when a small dovish signal caused a massive easing in financial conditions. That's not what the ECB is looking for. That said, we expect continued gradual reductions in rates in Europe. Turning our attention now at last to the US, we may not have to wait too long, actually, for the Fed to join the rate-cutting party. That's not what officials are saying at present, but it's certainly what the data flow this week started telling us. We saw the ISM manufacturing PMI, that's a measure of current activity, drop to a 3-month low. It's in contractionary territory meaningfully and well below projections. And importantly, only 40% of industries surveyed say that they see any growth at all in May. Construction spending Construction spending fell again in April, flying in the face of economists who expected an increase. And this dip in construction activity is starting to look like a trend now, more than a few one-off data points. And probably most importantly, the JOLTS survey of firm recruitment and hiring and firing showed a further softening in the labor market in the US. And overall, what we're seeing from this data set is that after a long and slow period of adjustment, the labor market is now back to where it was pre-COVID on aggregate, using that measure. So what we saw this week was, for April, was job openings plunging, and surprise, surprise, there were downward revisions to prior data too. And if firms aren't hiring, they're still not really firing either, though. So we're seeing this labor hoarding theme in the US continue to play out. That said, firm production is mostly down, and so the adjustment is happening via hours put in by workers rather than payroll in total for firms. But that's what usually follows next. This dovish macro news was the main driver behind markets this week, with the 10-year T-bill yield down 19 basis points at time of recording, and lower rates also pushed up the S&P 500 by almost 1.5%, although the Dow only managed 0.3%. Meanwhile, gold was up 1.2% on the week, and the dollar was slightly weaker as well. So all in all, a pretty dovish overall picture to markets. We think it will take a big inflation print or some serious change in stance from Chairman Powell to really shift the market narrative from what we're seeing as broadly bullish at the moment. But there is a sense that sort of economic enthusiasm and euphoria are dying down a little. Slightly more defensive mindset is creeping in. I think slowly investors are starting to position for a bit of a rolling over, although it could still go very much either way. Looking at the week ahead, and speaking of data that can change the narrative, we're recording and releasing just ahead of the non-farm payrolls report for the US. The labor market signal from last week's data should point to a relatively soft report, although we're continuingly emphasizing that the release has some of the most severe current inaccuracies in all of Dataland and is very much subject to downward revision, so take whatever comes with a big old pinch of salt. Looking to next week, though, if this was the week of the global easing cycle, next week the US data takes center stage again. We have the June FOMC meeting on Wednesday, where markets are 99% sure exactly that there will be no change in rates. The key there, of course, will be Powell's messaging on inflation and the outlook. But if you're worried about a damp squib Fed meeting, maybe the data will excite you. We're getting the latest read on inflation, both consumer prices and producer prices, which will be as important an indicator for what the Fed will do in terms of monetary policy as anything that Jay Powell says from the podium next week. So gear up for a big one in terms of the US rate outlook. Shifting gears now, we're going to address this week's Spotlight. And we're shining it in the direction of markets because we're highlighting a fascinating piece by our colleague, senior strategist Bhavana Chabra. And she's always brimming with ideas. And she's onto a great one this week, we think, inspired by the very unfavorable risk-reward profile we're seeing on the S&P 500, which is highly concentrated and trading at lofty valuations, as we've discussed before. So she dug into the broader equity universe and took a look at two other market indices, the S&P 400 mid-caps index and the 600 small caps, to see if there's any better value to be found for investors there. And what she found was very interesting. Earnings growth projections for the next 3 years for the 500 and large firms and for the mid-caps are almost identical and quite high at 11%. And the small caps are only a bit lower at around 9%. But markets are placing a very different valuation on those earnings projections, both in absolute terms and relative to how they've been historically valued. The S&P 500 is trading at around a 21 times price to earnings multiple. That's in the 90th percentile historically, so very high, very elevated. It is basically very costly to acquire the stocks that privilege you to future cash flows from those firms. Meanwhile, small and mid caps are trading at around 15 times and 16 times respectively, and they're both below the 50th percentile reading. So historically, they're actually underpriced relative to projections. So in other words, the price you have to pay now for future earnings on the S&P 500 is way more than for smaller stocks, and the risk reward is tilted very much in favor of the mid and the small caps. And it gets even more interesting when you break everything down on an industry level, Bhavana has a lot of rich detail in her report, so you should read that directly on our website. But a few highlights are that mid-cap energy stocks look extremely well priced, especially compared to the majors in the 500. We also love mid-cap electric utilities, which are benefiting from regional data center build-outs and energy transition strategies. And we also like things like small-cap pharma, where we're seeing some massive earnings upgrades. Although large cap also screens quite well as a stable defensive pick, but the chance for outperformance in the small caps is much better. There's a lot more where that came from, but those are the ones that caught my eye. And the overall message there is when it comes to equity indices right now, small is beautiful. So look at the S&P 400 and the 600 ETFs for a potentially very good bet. That brings us to the end of today's show. If you're listening in every week and you like what we're doing, please take a moment to leave a review, write us a comment or question, tell your friends, tell your colleagues. We'd love to hear from you. I'm Dylan Smith, and until next week, that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.